cool. So yeah, my name is Jordan Cameron Montel. Great, you said. Thank you for the kind words. I'm so excited and happy and grateful to be on this call with you guys. I'm excited to share the information because I know how this has really changed my whole trading game. So yeah, I'm going to kind of get into a bit about my story and then why I chose to trade in this institutional way. But to clarify, introduction to institutional trading is what we're going over today, and essentially all this is learning to trade alongside the banks, the institutions that are controlling the market that you're trading on. So I've actually been trading now for roughly 15 months, a year and just a little bit, and I've gone through strategy after strategy after strategy after strategy, and I've seen success in some, but never got that consistent success. And I was always wondering, I can see people winning. Why aren't I? And not to say other strategies are bad, because I believe as long as you have one strategy that you just keep honing on, then you will always make it work. However, there's certain strategies where you can, let's say, profit faster or build your account quicker than others. And I was a person at the time, I really wanted money, really wanted to get quick money, but I knew trading is not about quick money, it's about building long-term wealth. However, I saw people making money while risking the same amount I was risking, making so much more. So I knew there had to be a way that I could switch up the way I was trading so that I can start being more consistent and making that extra money. Now, I first came across this strategy when I was just scrolling on Instagram and saw a graph of someone else in IM Mastery Academy, one of the educators that I'll talk about later on, called Jordan Morgan. His Instagram handle is 7 Sources, and he was explaining to me just about institutional trading, and he was talking all this stuff about how the banks are involved, all of this. And at the time, because all I knew was support and resistance and trend lines, I was thinking, hold on a minute, what's this Chinese talk? I've been trading for a whole year and I haven't heard any of this. And then when he introduced me to this in around February, since then, I've been non-stop diving my head straight into it because this has changed my whole trading game. And I have testimony after testimony after testimony of people whose trading games have been changed just from understanding how the institutions do trade. So without any further ado, I'm going to get straight into the information. I am recording this and it'll be up on my YouTube after, which you can find. I'll send the links up for that after. But yeah, if you do have any questions, just drop it in the chat. Let me know. I'll try and go through them as I go. And yeah, let's get straight into it. So the first thing I want to go over is just to enlighten you on who runs the markets. Now, everyone knows the markets are run by the banks, the governments, the hedge funders, the investors, all of that. But who actually has the majority of the share? So when we look at this, we can see that Citibank were in 2016 the bank with the most money into the market. Now, if we know Forex is a 5.3 trillion or now a 6.6 trillion dollar per day industry, then 12.9% of that at the time is around 683 billion, 700 million in just one day. Now, I'll say that again for you. 683 billion, 700 million in just one day. See, when you look at figures like this, that's just a daytime figure, roughly. It's probably more by now. Yet we're here thinking we're big, using our standards, and we have 10K in account, 50K in account, 100K in account, and we're thinking, yeah, I got money. The banks look at you like you're a child. You are nothing compared to the bank because of how much money they're turning over every single day. Which is why it doesn't make sense to, when you're trading, to try and go against what the banks are teaching you, to try and what they're providing in the market, to try and go against what the banks are actually showing you, what you can trade. You're putting your strategies, your lines, your graphs, all these things, but if you just really break it down and think, okay, the banks are doing something to make that much money, let me find out what it is they're doing and copy that. And as simple as that. So we are the small fish in the sea. The banks, they are the big sharks, and there's a statistic that says 96% of Forex traders lose, which I'll show you what is the percentage of Forex traders losing. 96%. So I'm not making that up. There's a reason why this is 90%, 96%, and it's because people try and beat the banks. You don't have nearly 700 billion in your trading account. So you don't know what's going to happen. You don't control what's going to happen. So if you're trying to just guess and, put your money anywhere, of course you're going to lose. You may win a few trades here and there, but overall you will be losing. You might think, oh, I'm winning more trades than I'm losing, but because your risk reward is so poor, or you're pulling out of trades early because you want to secure your profit, you're not going to end up being a profitable trader. It won't be long term, and you will be you'll be in this 96%. But to get in that small 4%, in that 4%, you need to become these fish right here. And these fish are called pilot fish. These pilot fish accompany the sharks. They go wherever the sharks go and eat on the sharks' scraps. Now, if we have a look at this figure, would you, right now, put a 777 in the chat if you're happy to eat scraps of 700 billion? Because I know I'd happily eat 700 billion. Give me scraps. I'm putting sevens in the chat. I would love to have scraps of 700 billion, because when there's that much money there, you don't need to try and beat them because there's that much money. 700 billion. Come on now. So the reason you want to be these fish right here is because you're following. You're going wherever the sharks go, wherever the big banks go, you're just following that. So now I'll get into the fundamentals of how you can actually follow this. So as you all know, the banks have billions and billions of money, millions and millions of pounds, dollars, rupees, whatever it is going into the banks. But they can't just buy and sell the way we do. They can't log on to an MT4 and just hit buy on like 100,000 lot size, which I have seen. You do get lot sizes that big. They have to stack their orders. So they can't just, buy the same way we do. They have to manipulate the market in a certain way. Because if they were to buy the same way we do, you'd see the market fly up or fly down. They can't do it. They have to manage it. They have to stack all their orders. So when they're doing that, that means they're going to sacrifice a bit of money at times to potentially make more money. So in this example here, in the first one, we can see the banks have dropped the market, this red candle going down and then going up. So real quick, let's put some twos in the chat. If you've ever, say you're going to buy the market, I don't know if it's a trend, on a support line, whatever it is, you've put a buy stop, buy limit, but you've been stopped out, but then you looked at the chart and the market is still flowing up. Put a 222 in the chat if that was you, anytime you've been trading, if you've been stopped out before the move happened. Let's see if anyone's had it. Because I know 100% I have. There we go. Some people send it to me privately, but yeah. So you've had it where you've been stopped out before the move happened. And there's a reason why you were stopped out. The banks know exactly where your stop losses are, so they know where they can stop you out before the market goes in the direction that you got right. And you may think it's unlucky that you got the direction right, but you were stopped out, but it wasn't unlucky. It was done on purpose. So you need to understand that the banks know what you're doing, where you're setting your stop losses. That's why when you go to things like Baby Pips or YouTube, you see the same things over and over again about this, have your support line, have your stop loss about 30 pips or under the support, under the equal highs, and that's where you can have your stop loss. And because of these things, that's why 96% of forex traders lose, because they're all getting fed the same information. The information comes from the banks, which goes down to the mass news, it goes down to Baby Pips, goes down to YouTube, so there's more people doing it. And I understand why people are doing it, because it's easy. When things are easy, everyone can do it. But if it's easy, it means it's not worth it. So the way you can capitalize on this is when you spot something called an institutional candle, something called an FU candle, something called a stop hunt, a fake out, loads of different names, all mean the same thing. This is where the banks take you out before going back up. So this is when you got taken out of the move, but then the move still happened. And how you can capitalize on this is simply by identifying where that fake out, that stop hunt, the institutional candle happened. So we can see this red candle was where that move happened. So all we're going to wait for is the market to come back down to where that move happened and go back up. And that move there is called the mitigation. Mitigation essentially means the break even. So the reason why the banks need to come back down to this area, and I say the break even, is because this down candle, this FU candle, was a sacrifice. So that meant that when they sold down, they had to sell their actual money. So then maybe they would put 50, 100, maybe even a billion pounds down, because when they bought it, that was a few hundred billion, which flew the market up. So they sacrificed a small percentage of their account to move the market down before bringing it up. But if you were to sell at this black line right here, as long as it's below the black line, you're in profit, yeah? But as soon as it goes above the black line, you're now in drawdown. And because the banks don't use stop losses the way we use stop losses, that means they could be in drawdown for hundreds of pips. Because on the opposite side, they're also on the opposite side of the trade. So yeah, they're in drawdown here in this area, but as soon as they go upwards, they're now in profit on the other trade. So while we're up here, they're in drawdown, and the mitigation is where the banks come back down to close that selling trade, to close that sacrifice, to close that trade that was in drawdown. So they're now in break even, and then the market will fly up. So the main thing that we're going to be trading is the mitigation. That's the one thing you need to make sure you really hear from this. The mitigation is where we are going to be trading. That's where we enter. So I'll get into some chart work so you can see that in a real example. And as I said, I'm going to be showing you how you could have caught around 600 pips from this one pair alone in the last, from this point, 20 days. So nearly 3 weeks, how you could have caught just under 600 pips on just this one pair alone. So the main thing we're looking for is where the banks sacrifice money to buy money up. So if you remember this example of where there was a down candle before the up move, we're going to look for that exact same thing. So I can see right here, let's highlight it here, there's a down candle before an up move. Now, if we identify what that down candle has done before going up, we can see if it's a true FU candle, a fake out, or a stop hunt. So the first thing I'm looking for is, did it capture liquidity? Liquidity is simply a pool of money. Write it down for people taking notes. So by a pool of money, all I mean is where a retail trader, someone who's that 96%, is putting their stop losses, because where stop losses are, that's money for the banks. So if you're taught to put your stop loss on an equal low or just below, that means somewhere like this area here, we can see an equal low here, here, and here. So I would put this with dollar signs because that's liquidity. So I mark out that liquidity. I can see that's where the market is looking to go. But we notice how this wick comes down just below that. And you're taught, and a lot of strategies are, if the support level is broken, then you're looking to sell the market. So we can see how the market purposely breaks that support level, but then goes back up. Because people, when they get there, they have their sell stops. So as soon as it breaks that, they're starting to sell and they instantly lose. So people are losing on both sides of this trade because the banks know what you're doing. And how you could capture on this is identifying the specific candle that took people out. You identify this specific block red candle that was the stop hunt, the FU candle, the fake out. You identify it and then you go to the open. The open of the candle is where there's the most money inside that candle. That's where the banks, in the 4 hours of this candle, that's where the market opened for those 4 hours and where the banks sold the most money down. So if I can see that's the open, that means when the market goes above that line, they're in drawdown. So as you can see here, they have to dip back down before going back up. Just as it says here, you dip down to take people's stop losses out, fly up, then you have to come back down to close that trade. So before I continue, does that make sense? Someone put a quick 222 in the chat if that makes sense, and do you have any questions on that? If you do have questions, let me know. But before I carry on, let me just get any questions out of the way. Cool, making sense. Perfect. So that essentially is the strategy. That's institutional trading. You're identifying where the market takes people out, and then you capitalize on where they've taken people out, just on the mitigation. Go back to the image. Cool. So you can see if this is what we, let's go here. Let's get a pen. That hasn't worked. Let's try again. Okay. If this is what we call the pool of liquidity, this is the candle that's taken them out. So this is now known as our FU candle. This candle right here is the FU candle, because all it has done is come down and said FU to all of these people, all these traders, all these 96% who have the stop losses here. But the banks didn't want them to move the market down. They were doing that to manipulate you to think the market's going down, but then it goes back up really quickly. And then they have to come back down to break even. So I'm going to quickly go through a few confirmations to why when you want to get into the trade, so you know it's going to be a confident, good trade. So if you want to screenshot this, take notes, whatever it is, do that quickly before I go back on. So these are the 5 things that you want to bear in mind when you're going to take this trade. So when you screenshotted this, just put a 222 in the chat, because it'll be long for everyone taking notes. But yeah, take a picture, screenshot, whatever it is, and then put another 222 in the chat when you're ready to move on. Cool. So I'm going to break down all 5 of these confirmations now, but I'll go into detail for only some of them, just because of time. So the first one, the institutional candle captures liquidity. So that's exactly what we spoke about with this FU candle captures all of this liquidity. That pool of money that was identified with this line and the dollar signs was captured. So it went below and took out all of that money. So that is confirmation 1 complete. The next one, the following candle engulfs the next candle. So if you look at the liquidity candle, the institutional candle, we can see the following candle engulfs it. So the size of this candle is bigger than this one. It engulfs that candle. It's significantly larger. So that's confirmation 2 complete. Imbalance before the institutional candle. Now, imbalance is something I'll go into either the end of this or in a future lesson, so you can get more detail. But essentially, imbalance is where there is majority of one movement in a candle. So we can see, I would say in this example right here, this zone I've marked is imbalance, because in this area, there was only selling. In every other candle in these spaces, there's candles on both sides of it. But in this area, there's only downside movement, which is called imbalance. And this is unhealthy for the market. The market's run on algorithms, so there has to be certain things that happen so that market remains healthy. Again, imbalance in this space here, where there was no buying activity, it was pure selling. So that's 3 out of 5 confirmations. Next confirmation, there's a target area. So I have a double top of double bottom. A target area is simply where the 96% have their stop losses. So I can say there's a target area here with these equal highs. I can also say there's a target area here with these equal highs. So that's 2 target areas on the upside. So we know we're now looking for a buy. Confirmation 4. Now the time taking the trade is at the local bank's opening. So this is something I kind of personally discovered when I was going through all the different pairs, that different banks activate on different times. So for a USD pair, the main time you want to be looking at is 7 to 10 Eastern time, which is 12 to 3 p.m. GBP time. So let's put that here, 12 to 3 p.m. London time. And we can see in this market here, in the 4 hours, the candle started at 10. So within that 4 hours, there's 4 hours after. So that means it goes up to 2 o'clock, which means the 12 o'clock candle was inside this candle here. So that means it's within that time frame. So that's confirmation 5. again, so same with the mitigation, it was in that 12 o'clock time frame, which means confirmation 5 is here. So 5 out of 5 confirmations for you to take this one buying opportunity right here. But now I'm going to show you something. I'll blow your mind on how you could have caught every single move from here to here, from here to here, from here to here, from here to here, and here to here. So if we clear this off, let's blow your mind. So we'll go into the 2-hour time frame. That's one of my personal favorite time frames to look at all the different candles. So the first thing we're going to do, as I said, is we mark the areas of liquidity. So I can see, this is before, we had this area down here. There's also liquidity in this area, and also liquidity in this area. So that's 3 points of liquidity. So if I look in this space here, I'm going to spot how many times or where the market has taken out liquidity before making a move, where it's taken a fast move and then reversed. So the first one I can spot is this candle down here. So if we zoom into this down candle took out this liquidity in this area. So if we just go back to this, that down candle is this FU candle. We can see that support area. It's taken out and then it goes up. The support area here is taken out, it goes lower, and then it goes up. So if we do that same thing where we use the horizontal ray tool, which is here, horizontal ray, and again, go to the open of that candle and draw a line. And just to make it a bit clearer, I'll delete this. So if we just follow this one line from here, all we have to do is be patient. You set a pending order on this line, and then you leave it to wait. I'll talk about stop loss and take profits shortly, but first we'll just go through the entries. So you set your pending order on the open of that candle, and then you just wait. You wait and see it came close, didn't quite activate. It came close again, didn't quite activate. Came close a third time, still didn't activate. See, most people at this point would have FOMO, fear of missing out. So you would hop into the trade early because you think you want to catch the buy. But if you're patient with your trades, you will not miss any trades. And then we can see here how the market dips in and flies up. Now, to explain the reason why the market acts so quickly in this area is because the market has no reason to stay in this area. The reason that the market even came down here was because this whole time the banks were in drawdown. So I'll show you what I mean by that. This candle here marked in the green was a selling candle. So the light blues are take profit and the purple is drawdown. The banks don't have stop losses. So it's basically infinite. So that means you can see, judging by this darker area, this whole time, the banks are in minus until they get to this point. That break-even point is where the banks close the trade. Now they're out of the trade, they're ready to put more money in the buys. Now you can see, look at the size of the candles on the buying side. This is why there's so much more money there. You can see it. Look how quick it jumped from here, a quick 35 pips, whereas on the way down, it took how many hours? It took 20 hours to do that same journey, when here, it took 4. And then again, the same thing. Up here, up here, up here. You can see the patterns. You can see the direction the banks really wanted to move the market by the speed it's going in. So that's entry 1, caught here. Mark that, entry 1. Terrible one, but you know what I mean. And entry 2, we already analyzed before, which was from this candle here with the no drawdown. It's entry 2. And then entry 3, actually no, entry 1 I missed out. Entry 1 is in this area here. I'm going to show you how you could have caught the entry on this wick. When you see something like this, where there is loads of wicks, every candle has a tail. Every candle has a story within it. So all I have to do is just break down to a smaller time frame. So if we go to the 15-minute, find that zone again, you can see the exact same thing within that. So I can see on the reverse side now, this candle was the last big up candle that took out, that captured liquidity on main confirmation, liquidity being all here, all of this being liquidity. This candle was the one that pierced it. This was the candle responsible for breaking that liquidity. So that's the candle that we're going to trade off. That's the candle we put our entry on the open of. Again, wick entry, minimal drawdown. What's that? 1 pip drawdown to then fall to where your take profits would be of the liquidity, the targets, the double bottom, double tops. So on this line, liquidity there, let's round that to 100 pips. That's a 1 to 10 risk to reward ratio. 1 to 10 risk to reward. That's how you can grow your account, because if you're risking 3% on, let's say, on £1,000 account, that's £30 on that £1,000 account. That means you can have a stop loss, a lot size of 0.3. Most people won't have that on a £1,000 account using correct risk management, because if they do, they'll blow their account. 30 pips on 0.3 is £90, but 30 pips with a 10 pip stop loss is still £30. But if I was to make this 30 pips as a standard stop loss size, and I still wanted to risk 3%, then my lot size has to be 3 times smaller. My lot size now has to be 0.1. So on this trade, I would only make £100. But if I done it with an institutional strategy with 10 pips, I'm now making 3 times that. I'm making £300 because I can identify where the market's going to go. So on the same trade, we're putting a tiny bit more effort in. You've now tripled the amount of money you're going to make. That's the power of this. So that's 3 entries. Here, 3 entries. Next, I'll get into imbalance. So imbalance I briefly spoke about before, but I'll go into more detail what imbalance actually is. If any of you guys have ever used a crayon, in primary school or whenever in life you used a crayon, you know if you were to really quickly draw a line across a piece of paper, you wouldn't get something like this. You wouldn't get a straight line like that. You would get something like this. Something with loads of tiny gaps in, because a crayon just doesn't quite move the same as a pen or a pencil. It has loads of gaps when you draw. See, the market moves the same way. When it moves fast, it leaves gaps. And those gaps aren't healthy for the market. Those gaps aren't healthy to be there. Those gaps always have to eventually be filled. You have to come in after and fill those gaps, because the market can't survive long term with them. It's unhealthy for the market. So in the same way, I see everything there. Let's bring it back. In the same way that the crayon has gaps, the market also has gaps which need to be filled. So anything like this, like this, and like this would be examples of imbalance. So again, before I move on, just put a quick 333 in the chat if that makes sense, if that you understand what I mean by imbalance, or if I need to go over that again. Cool, perfect. So you understand imbalance. So imbalance has 3 purposes, and I will go through all of them now just so you can understand it. So imbalance is when the candle is only in one direction in that space. And the 3 uses for it is 1, a place for your take profit, 2, confirmation for your trade idea, like I said before, and 3, an area of re-entry. That is poor grammar. This should not be here. So we'll go from number 1, an area as your TP. So when you're trading from these buys here, for this one or this one, 2 areas of take profit you could use imbalance for would be in this one here, number 1, and this one here, number 2. Because if you know that imbalance has to be filled, if you know that that's an unhealthy part of the market, you know the market has to go there, that's an area for people to take profit. There's no point putting it at a random fib level or a random part of the market for no reason. But if you know that the market needs to fill this area, that's a real confirmation that you should take that trade. That's a real confirmation that that's where you should be able to take profit. So that's one example of where to take profit. So you could have got out when the market got to this part or got to this part. Another area is when it's is a confirmation for your trade. So I spoke about earlier, if we said we're looking for a buy, a reason for us to take that buy is that the market has to go up anyway, because it needs to fill in this imbalance and it needs to fill in this imbalance. And the final and my actual favorite use of an imbalance is an area of re-entry. So the banks like to stack orders. So I like to stack orders. If they're getting into the trade again to make more money, I'm going to get in the trade again to make more money. So I'll show you the 3 imbalance orders and how you could have got into them. The first one being in this imbalance right here. So we've identified this as somewhere where we're going to place our take profit. So after you've identified this liquidity and this area, that's a very, very hot point for us to put our take profit. So if we bought here, again with our minimal stop loss and our take profit at the beginning of the liquidity, that's 6-to-1 risk to reward ratio, 14 pip stop loss and a 93 pip take profit. And we put our take profit here because this is where the liquidity and the imbalance is. So this is a very popular place for the market to reverse. So all we need to do to now capitalize on that liquidity is see the direction that liquidity was going in. We can see it was on the downside. So that liquidity we're going to jump into will also be on the downside. So we're going to look for a sell. And how you best take advantage of liquidity is by drawing a fib from the top of the liquidity to the bottom and identifying the 50% to the 62%. It varies depending on, so it's up to you and how you choose to use the strategy, something I advise to backtest. But I personally float between the 50 and 62, so I tend to put it in the middle. And that there is my entry, with the stop loss being at the end of the liquidity. Because your stop loss shouldn't be in a random place like 30 pips or under a low. Your stop loss should be in a position where if the market hits that place, your trade idea should pull out, because the trade idea you thought of isn't going to take place. If you thought you were going for a buy, you placed a buy limit, a buy stop, and the market goes too far below, the reason you want your stop loss at that certain area is because the buy idea is not coming to play. It's gone to a position now where the buy won't play because it's gone too low. So if I'm going to play this imbalance sell, if it goes above, I'm not going to carry on selling, because that's not what I'm trying to play. I'm not trying to play any sells above this area. I'm trying to play imbalance. So if I'm playing imbalance, I'm only going to trade in the imbalance area. So if that's my entry and stop loss, entry in blue, that means my stop loss is 5.3 pips, tiny stop loss. So now risking 3% on a £1,000 account, I can now have 0.6 pounds per pip instead of £3. Now, instead of on a 100 pip take profit, I'm not making £300, I'm making £600. So on this trade, I can see, looking back here, what is the market done when it's got to this area? It's flown up, it's flown down, and come back up. So when we look at this, we can now analyze this market. We can see what is going on. A very, very fat candle going up. A fat candle means when this, let's go here, cut that out. If we look at that candle specifically on the edge here, when that happened, there was a lot of imbalance within that candle. When a candle is fast, that means it needs to recover. We can see here, it spiked up and followed back down to recover. So when a fast candle happens like that, you don't want to play it. It's a very dangerous time to play the market, because there was maybe news, there was something going on why you shouldn't play that candle. So me personally, my advice to you, what I do myself, when there's something like this, you don't want to play after it. You don't want to play during it, because unless you're a very, very experienced trader, you're risking your money for something you don't know about. When news happens, people tend to guess because, you know, they think a big move's happening. They don't want to lose out on the pips that might come. Yes, that's true. The moves will happen a lot quicker, but that means you can blow your account a lot quicker. That margin call will come a lot quicker if you're on the wrong side of it. So wait for the market to have this nice, healthy, slow movement. Because when it's slow, it grows. When it's fast, it doesn't last. Remember that. When it's slow, it grows. When it's fast, it doesn't last. So if we ignore the fast price action, because that's not where we'd enter, that's the unhealthy price action, and go to the healthier price action where it's slow, we can see, it's gone. Where it's slow and healthy, the market has tipped in and then dropped back out. And you say, where would you take profit? Where would you exit? We do the same thing on the reverse side. We can see where it's fast, it doesn't last. So this is all imbalance. This area is filled with imbalance. And if we go again to the open, and that's the all around, the open and close of that imbalance area, we have our two entries of the 50 and the 62. So in the middle, like I said before, a wick entry, and then slow, healthy price action going above. And then again, the same thing with the fast, unhealthy price action. We have the area of entry in here. It's getting messy now. And then we have the price action after. So you can see how you could have now caught the moves up, down, up, down, up, down, just on understanding what the price action is doing. So if that makes sense, put a quick 444 in the chat if that makes sense before I go into the more nitty-gritty part of this. It's a basic overview of institutional trading and how you can capitalize on the markets, understanding what they do. As well, if you have any questions, let me know. I'll come again. Please come again. What part? I kind of went over a lot. So what part would you like me to re-explain? Get a quick about imbalance. Cool. Using as an entry. So let's just wipe this clean. So I'll use this example here. Imbalance is where you see, do you understand what imbalance is? It's where you see the market move very fast and leave a lot of empty price action within that. So this, I would call it as imbalance. We'll go through that in a second. So this is imbalance here. So how to trade imbalance is first you identify where the imbalance is. So I identify it by looking at the 3 candles before and after that area and seeing, okay, where was the imbalance? So in this space, there was pure buying action. Here, up until this candle, and you can say, leave it there. This area was pure buying action. So what you want to do, in the direction the market went, so we can see it was a buying action, it was going up, you draw your fib from the bottom to the top. Then your entry area is the 50% to the 62, something you want to backtest yourself to see where your entry area is. Like I use 62% instead of 61.8 because I find it's more respected. But yeah, so you want to find that area and draw that out. And what you're looking for is the market to come and dip down, close that imbalance and go back up. And the reason is 50 to 62% in that region, it doesn't need to do the whole thing, is because, you know, when they say, oh, 5 plus 5.5 is 10.5. So you can round that half to 11. This is used the same way. As long as at least 50% of the imbalance is filled, they can round that up and say the imbalance is filled. The whole imbalance is filled because you only need 50% for the whole thing to be filled. So you put your entry in the 50 to 62% region, your stop loss at the bottom of the imbalance, your take profits the same at the targets, and you get your entry. Most times it's a wick entry, but this is something you can use to stack your orders. So if we've already entered a trade from this wick, which we identified earlier on in the session, another trade from this wick earlier on in the session, another trade from this wick, you could all have the same take profit area. Let's say top here. So that's one trade of 123 pips. Again, here, another trade with 107 pips. So that's 230 pips. And then another one with the imbalance, same area, 70 pips. So that's now 300 pips in these three simple buys by identifying a very, very small thing that happens in the market. Something that most people wouldn't notice, but when you see it, you can't unsee it. You can see, let's go to the first time. This down candle right here, pushed down and took out this liquidity. So you mark the open. Then if we hop onto the 4 hour, we can see this down candle pushed out this liquidity. So you mark the open. How we got that entry. So that's 1, 2 entries. And the last one on the imbalance, on the imbalance in this area, we got the third entry. So in this space alone, 12 days, that's 300 pips on this one pair with very, very, very minuscule drawdown. And to answer this iPhone's question, to the GBP pip move, the reason, GU said, the reason it hasn't hit the, how come that wasn't respected? Left it, okay, so the reason, let's clear this first, it wasn't respected here is because this wasn't a part of the actual market's move. This happened when there was the referendum. It happened when there was big news involved. So this wasn't what they intended. But if you look on the chart, there's still a lot of downside. Name's Harry. Nice to meet you, Harry. You can see there's a lot of downside area for the market that needs to go down to. So we can see they don't want to go up. They want to fill this liquidity, this imbalance. But the main reason that I personally think that they went up was just to ruin people's lives. They were trying to take people's money, because when everyone knew Brexit was coming, the referendum, all the action, people assumed that the pound would go weak, because usually when news like that happens, when the big Brexit drop was initially announced in 2016, everyone saw the pound drop. So everyone still expects the same thing's going to happen. They expect to see that huge 1,000 pip drop. Let's see if we can find it here. Everyone expects this. The banks know people are expecting this. How big was that move? Nearly 2,000 pips. 2,000 pips happened in the space of a few minutes, just because of that one announcement of Brexit happening. So people always assume any news related to Brexit now means the market's going to drop. So that's my personal view as to why they flew the market down like that. Another one could kind of be on trend lines, but I won't get into that now. But that's my personal view on why they flew the market up and then started coming down. So imbalance isn't something that you want to trade solely. As I said, it's something you want to use as a confirmation, a place for your take profit, or an area of re-entry. So if you're already in that buy, it's an area of re-entry, not something that you solely want to trade buy or sell. What is the time right? It's 8:50. So just to finish off, I'm going to go to one last example. Again on EURUSD, but not including this. That's my favorite example in this trading space. And this actually shows manipulation in the market. This is why people who trade trend lines are in that 96%. Not everyone who trades it loses, but most people do, because the banks know you're trading the trend lines. And another reason is because they're subjective, but that's just my opinion. So if we look at this market, we can clearly see we are in a huge downtrend. Huge downtrend. So from this area, I don't even know how to copy draw a trend line anymore, but it would be something on the lines of that. You know, people kind of make it fit how they want, but something along those lines, that's your trend line. So it means when the market gets down here, you're going to carry on drawing the trend line and get ready for the sell. Now, I know a lot of people were actually in the market for the sell. This is one of the most popular trades I've ever seen. Everyone was putting on the chat, showing screenshots. oh, sell USD, hit the trend line, hit the 61.8, whatever it is, everyone was saying to sell it. But then after, the bank flew the market up. See, you know, that's normal for a trend line. People say, oh, once it's hit 3 touches, it's no longer valid. Okay, cool. So it's hit that trend line. So when people trade trend lines, they're taught when the trend line breaks to buy the retest. Now, on that retest, you're expecting the market to go the opposite way of the trend line, which it did. You know, it hit the retest, it hit that bounce, and started moving up. So now people are again showing the screenshots. I'm in profit. I bought the retest. You guys got fooled thinking it was going down. I knew it was going up. Okay. 40, what's that? 30 pips in profit. The market's going up. And then it tanks. Again, the market falls down and continues the downtrend. So how do the trend traders explain this one? How do you explain a trend that's been purposely taken out of and gone back down? Manipulation. That's it. It's purely manipulation. And when people start to realize that the markets they're trading is being manipulated, you'll start to become more profitable. And how you could have caught this manipulation was, one, you could have caught the sell on this candle from identifying this one right here. There's actually 2 entries on that. This big candle up here before was made it available for you to get this, and again this. And then how you could have again capitalized on this one candle, do the same thing. Mark the open, wick entry. This one had like I caught this one. It's like 161 pips drop with literally no drawdown on that line. 165 pips from no drawdown. And that's why you want to start to understand how the market is going to move. So yeah, I've been on for just under an hour now. So yeah, that's all I'm going to go through today. This is kind of part 1, more of an introduction, more the basics, because this stuff you can really start to hone in on and start to go smaller time frames and learn about the different schematics. But stuff I'll go into next week on the part 2, which is a more advanced session. But I know there's a lot of people asking me to do more of an introduction because there's so many new people. So, you know, if you guys got value from this, if you guys have learned something, put a quick 777 in the chat before I do hop off. Do you see USD filling imbalance at the moment? There's no actual imbalance that I've seen that is still here because, as we said before, it's covered this one because of the 50%. It's covered this one. So yeah, currently I don't see any imbalance in the market in any of these spaces. Cool, loads of 7%. So guys, I really appreciate your time for coming on. You know, it's Thursday evening. You can be doing anything, but you're here on this call actually trying to better your trading experience, better your trading profits, and better your whole trading. So, you know, I really appreciate this. Who can watch more? So if you do want to learn more, simply go on to Go Live. So I'll show you who I watch. I am Center. Nope, one. Go on to I Am Center, go on to the products, Go Live. And this is the people I watch, the people who taught me everything. Sure. Called Jordan Morgan. To log into their session. They have a whole team of people teaching institutional. So the people you want to really study are the Trade House crew, the team. They call themselves the Trade House. What is going on? Why is this not searching? Let's just go back. That is very weird. With me. Windows. Okay, it's kind of bugged out. With me. I'm not actually sure what's going on with the Go Live, but oh, here we go. So yeah, the people you want to see to take this down is number 1, Mike Miles. If you want to take notes on this, or actually, I might do this. So first is Mike Miles. Next is let's get rid of this. 1 second. Is this the course that's currently 170? Yes. Yeah. So if you're not, actually, I don't know how you're in this webinar, but yeah, if you're not in the I Am a Mastery Academy already, then yes, this is what you do want to be purchasing to get access to these educators. Number 2 is Sandy Kasper. I personally don't watch him, but I know he's in Trade House and he teaches these same concepts. Just because of the times he's on, 5 p.m. kind of midday, I'm not actually around at that time to watch these sessions. Number 2 is, where's he gone? Zach McDonald. This is another one very good for beginners. Zach McDonald is someone I definitely recommend for beginners. So 4 p.m. Eastern, which is 9 p.m. UK time. And lastly, my personal favorite who I look at is Jordan and Zach. These 2 are the legends who taught me everything I know. Jordan Morgan and Zachary Hogan, I owe all my profits from February to them because they dropped the source. Like, they really introduced me to these concepts. So if you want to learn more about this, definitely plug into these educators and yeah, go from there. So if you guys have no more questions, I hope you really enjoyed the session and I will see you next week for part 2. Peace.